This is an important update for anyone who receives Social Security, Supplemental Security Income, Social Security Disability Insurance, VA benefits, or any federal retirement payment in the United States. Recent changes in banking procedures and subtle adjustments in how deposits are processed could affect the timing of when your money appears in your account. Some people may notice that their benefits arrive earlier than usual, while others may find that their funds are posted later in the day or even on the following business day. It is crucial to understand that these changes do not mean payments are being reduced or withheld. Instead, they reflect shifts in the way banks manage and release funds. Being aware of these changes now can help you avoid confusion, missed bills, or unnecessary stress in the future. For decades, Social Security payments have operated on a predictable schedule. Seniors and beneficiaries could plan their rent, groceries, medication, and other expenses around the day their payments arrived. Many people became accustomed to checking their accounts early in the morning and seeing their deposits waiting. The change is not in the Social Security payment calendar itself, but in the way banks receive, verify, and release these payments. For people living on fixed incomes, even small shifts in timing can have a significant impact. At the heart of this adjustment is the process by which electronic payments move through the banking system. Social Security payments are sent electronically using a system that transfers money from the federal government to financial institutions. Historically, most banks process these payments overnight, posting them early in the morning. This is why so many beneficiaries were used to seeing their money just after midnight or very early in the day. New banking rules, updated processing windows, and enhanced fraud prevention measures are quietly changing this pattern. Banks are now required to conduct stronger transaction verifications, monitor unusual activity more closely, and comply with updated federal standards. These measures are designed to protect account holders and strengthen the financial system overall. While these protections are beneficial, they also mean banks may take longer to release incoming payments. In some cases, funds arrive on time at the bank, but are held for several hours before being posted to accounts. The rise of early deposit programs adds another layer of complexity. Some banks and prepaid card providers advertise early access to Social Security benefits, sometimes allowing recipients to access their money 1 or 2 days before the official payment date. These programs are optional and vary by institution. While early deposits can be helpful, they create inconsistency because not everyone receives their benefits simultaneously. Two people with the same official payment date may see their deposits appear on different days depending on the bank. It is important to remember that this variation originates from banking procedures, not the Social Security Administration itself. For seniors who have always relied on a consistent schedule, these changes can be unsettling. Some notice that their deposit now appears later in the morning or afternoon, rather than at the usual early hour. Others see a pending status for several hours before the funds become available. Occasionally, deposits may show up on the next day due to weekends, holidays, or internal processing adjustments. These practices are legal and compliant with current banking regulations, but require a different approach to financial planning. Timing delays can cause real-world issues, even though they are unrelated to the benefits themselves. Automatic bill payments may attempt to process before funds are available. Debit card purchases could be temporarily declined, and late fees may be applied even when the payment technically arrived on schedule. Part of the reason banks are adjusting timing is due to the increase in payment fraud targeting seniors. Criminals are increasingly attempting to redirect benefit payments, gain unauthorized access to accounts, or exploit timing gaps. In response, banks are adding security checks that, while protective, can slow down the release of even routine deposits. Federal payment system upgrades also contribute to timing differences. The government has been modernizing the systems that send large volumes of money, improving efficiency and reducing errors. While these improvements are beneficial in the long term, periods of adjustment can cause temporary delays as banks adapt to new settlement standards. Everyone receiving electronic benefits, including Social Security retirement, Supplemental Security Income, Social Security Disability Insurance, VA benefits, and survivor payments may notice these differences. The timing of your deposit is directly influenced by how your bank processes incoming payments. making it important to understand your institution's procedures. A common misconception is that the payment date listed by Social Security guarantees immediate access to funds. In reality, the date indicates when the money is sent, not necessarily when it becomes usable in your account. In the past, this gap was minimal and often went unnoticed. With new banking procedures and processing rules, the interval can now be longer and more noticeable. Weekends and federal holidays can further complicate timing. When a scheduled payment falls near a non-business day, some banks release funds early, while others wait until the next business day. There is no universal rule, so consistency is no longer guaranteed. For those living on fixed budgets, even a few hours difference can have consequences. Rent or mortgage payments due in the morning can become stressful if deposits arrive in the afternoon. Understanding your bank's posting policies is now as important as knowing your benefit schedule. Some seniors have switched banks or payment cards to take advantage of earlier deposits, though this approach is not a guarantee. Early deposit programs are subject to internal policies and may change based on security concerns or updated regulations. The emotional impact of these timing changes should not be underestimated. For many older adults, financial stability is closely tied to peace of mind. Uncertainty around deposit timing can increase anxiety. Knowing that these adjustments are system-wide rather than personal can help alleviate some of that stress. Late or delayed funds caused by bank processing do not reflect a problem with eligibility or benefits. Awareness and preparation are key tools for reducing anxiety and regaining confidence. Practical steps can help seniors adapt to this new environment. Maintaining a small buffer in checking accounts can prevent overdrafts if a deposit is delayed. Adjusting automatic bill payment dates can also align spending with the arrival of funds. Even minor changes, like moving a payment by 1 or 2 days, can prevent late fees and unnecessary stress. Reviewing deposit histories allows recipients to recognize patterns in how their bank posts payments, helping them plan more accurately over time. It is important to recognize where responsibility lies. Contacting Social Security about a delayed deposit usually does not resolve the issue once the payment has left the government. Delays generally occur after the funds reach the banking system. Knowing that banks, not Social Security, control posting times can save valuable time and prevent frustration. Communication around these changes often lags behind system adjustments, so staying informed is critical. Not every delay signals a problem, but every shift in timing deserves understanding. Different financial institutions operate in varying ways, which affects deposit timing. Traditional banks often follow strict internal schedules, releasing funds according to set posting times. Credit unions may release funds sooner but still comply with enhanced verification rules. Online-only banks and digital services often promote faster access, though early deposits are never guaranteed. Prepaid benefit cards follow yet another set of practices, sometimes releasing funds in stages or showing pending balances before full availability. Understanding your institution's approach is vital to prevent confusion. Even small changes to your account setup can temporarily affect timing. Updating bank account numbers, switching institutions, or adding new direct deposit instructions can trigger additional verification, causing short-term delays. These adjustments are routine security measures, not indicators of problems. For seniors who recently changed banks, monitoring the first few payments is essential. Timing usually stabilizes once the account is recognized as established and secure, though it may not match past habits exactly. Automatic payments are particularly sensitive to these timing changes. Many seniors schedule bills to coincide with the arrival of benefits. Later posting times can cause withdrawals to occur before funds are available, leading to overdrafts or declined payments. Adjusting bill due dates can reduce this risk. Even small adjustments create a buffer that aligns spending with the realities of new banking practices. Awareness of bank policies and proactive management are more effective than expecting deposits to appear at the same hour each month. Banks are not required to release funds immediately. Regulations allow financial institutions to set reasonable posting schedules as long as they are consistent and disclosed. This means the responsibility for timing often rests with the bank, rather than Social Security. Increased coordination between banks and federal systems can also introduce small delays. Technical issues, system updates, or high transaction volumes around holidays may temporarily slow posting even when payments arrive on schedule. The emotional connection to benefits is another consideration. Social Security payments are more than income for many seniors. They represent security, independence, and dignity. Delays or uncertainty around access can undermine confidence. Acknowledging these emotions and responding with clear information and preparation is key. While these changes affect millions of Americans, seniors are particularly impacted due to reliance on fixed income and limited flexibility. It is essential to separate banking practices from Social Security itself. Benefits are not disappearing, being secretly reduced or intentionally delayed. The program continues to operate according to established schedules. What has changed is how the money moves after leaving the government. Understanding this distinction can reduce fear and misinformation, helping seniors focus on proactive planning rather than unnecessary concern. As banking practices evolve, staying informed is the best way to maintain financial security. Monitoring deposit patterns, understanding your institution's procedures, and planning for small timing shifts can prevent stress and disruptions. Flexibility, awareness, and preparation allow seniors to navigate these changes effectively. While the financial system continues to modernize, those who adapt will retain the confidence and control they have always relied upon. In summary, new banking rules and updated processing standards are quietly affecting the timing of federal benefit deposits. Funds may appear earlier or later than in the past, and this variation is influenced by the specific practices of banks, credit unions, online services, and prepaid cards. These changes do not reflect reductions or delays from Social Security, but are part of broader efforts to strengthen security and efficiency within the financial system. Seniors and other beneficiaries who stay informed, plan proactively, and understand how their bank handles electronic payments will be best positioned to maintain stability and peace of mind during this transition.